All right, so this will be the review for the midterm. As I said before, you just go on Blackboard and take it. During the next week, it opens up on, I believe, on the 12th. It's in the syllabus. Anyway, 40 questions, multiple choice, 60-minute time limit. And obviously, if you're already watching the video, you're well ahead. Um, there's not going to be that much math on it. There's whatever. If you were taking it even in a classroom or a proctored setting, you could still use a calculator because it's that's not really the subject of this test. What I'm going to do is I'm going to read through. I've got the test in front of me, and I'm going to kind of look at each question and make sure I can just kind of focus your studying on what the relevant material is. So you'll kind of see as we go along. So, for example, one of the concepts which we're going to talk about is opportunity cost, and we discuss this a lot of times in relation to personal finance, but it can be anything. If you're doing something with your time, doing something with your money, it precludes you from doing something else, right? So if you spend whatever, let's say $1,000 a month on a car payment, that's obviously $1,000 a month that you are not going to be, using for investing. Or if have whatever habit that you have that costs you, 5, $10 a day, that's, can be 150 to $300 a month of money that you're not going to have. And so anyway, that's what opportunity costs. It's something you forego. Every it's physics or finance or whatever. Every action has a action reaction. Um, if we're looking at further on opportunity costs, yeah, if you've got say student loans out there and you know rather than pay them off, you decide to treat yourself with some consumer good. Again, uh, any sort of debt that you have out there, especially something like student loans, it's going to delay your savings. It's going to delay your probably your ability to buy a home and all the rest of that. So um, anyway, it all ties back into opportunity costs. We talked about retirement planning and in terms of when it should begin. Obviously, as you know from the charts, the time value of money. The earlier you can begin, the better off you're going to be. Waiting for whatever particular reason, you would have to put in so much money later on, whereas percentage wise, you could even use a smaller percentage and you know, obviously a much smaller dollar amount, and it'll be worth so much more because you'll have the time value of money working for you. Um, if you do get in a situation where you're basically living beyond your means, your spending exceeds the amount of your income, you need to get that under control, reduce your spending. So you can do some temporary measures, working more hours, second job, all that kind of stuff, but those are not really fixes. Those would not be a best option because all those things are quite limited. And anyway, it's more of a discipline issue and being able to live within your means. When we talk about liquid assets are assets that can be converted into cash quite quickly, right? Or cash itself. So things that are not liquid assets are, real estate obviously takes a while to get money out of that. You got to find a buyer. You've got a lot of process to go through. Or things in a retirement account, it may take you a little while to get that money out, and then obviously it's going to be subject to penalties and the rest of it. So wouldn't necessarily be considered liquid. Um, when we talk about liabilities, short term versus long term, remember the pardon me, definition we use for short versus long is 1 year. So anything that's typically held over a year, like, you know, home, car loans, things like that, Those would be considered long-term liabilities. When measuring a person's wealth, what you're typically looking at is the net worth, right? Just because somebody has a huge home um, doesn't mean that they're wealthy. If they've got a huge loan on it, then they may actually have a negative net worth. Um, but what you need to do is you need to get your assets minus your liabilities. So everything you own would be your assets in a dollar figure wise, and everything you owe would be the liabilities. So, why do you need to monitor your debt level? Well, because it can get overwhelming. It needs to be something that you can cover within that cover your monthly payments or whatever. So it all ties back into liquidity and other items. It's not just how much you have, but um, whether you can service the debt that you do have. Service the debt meaning paying the bills. Um, we talked about compound interest, and the concept with that is that you know money today is worth more than money in the future because you can invest that money given today. So if you're given the option of a certain amount of money right now or a certain amount of money 30 years from now. Obviously, the money now, because of compound interest, and compound interest is earning interest on interest. That's what makes it so powerful. Um, yeah, a couple three questions on compound interest. Here's one on taxes. We talked about different categories. Some are easy in terms of filing status. So you've got single, married. Now, if you're married, you can file jointly or you can file separately. And then there's another category for head of household. And the head of household, that is somebody who's single but also has a qualified dependent. Um, Simple stock problem where a lady buys and sells an asset. But the question is whether it's a short or long-term gain. And again, 1 year is the cutoff for short or long-term. What types of interest are tax deductible? So, consumer things like autos, homes, vehicles, any of that kind of stuff, vehicles being boats and other stuff, RVs, none of that's tax deductible, but home interest is. Um, Another question on liquidity. It's about quick access to money. Um, Although credit cards provide a source of quick access to cash, you do have to consider the finance charges if you can't get it paid off within that month. And again, if you are able to get it paid off within a month, then you're getting the money basically for free. You're a convenience user. Stopping payment on a check. Um, it's not as relevant as it used to be because checks clear so quickly now. If you're going to stop payment on a check that's written, you need to do that before it's presented to the bank, and often that's done electronically now. So it's typically used now for lost checks or things like that. But even the significance of checks is dwindling and probably going to continue to go down. Um, Talked about overdraft protection. So if you have that on your checking account, typically that account is tied to a credit card, wherein if you write a check or use your debit card, typically a debit card won't even process, but if you say you write a check for more than you have in the account, um, a overdraft protection will prevent you from being overdrawn and incurring all those charges. Um, If you're borrowing money for everyday living expenses, yeah, you've got an issue. typically not a valid reason to be borrowing money. You should be borrowing money for, long-term needs, but to be borrowing money for groceries and rent and things like that is typically a problem. Pay off your balance every month on a credit card and you will pay no interest. Um, if you take a cash advance on a credit card, what happens? You'll find out very quickly. The interest rate, there is no grace period. They'll start charging you interest from that moment, and there'll usually be a fee paid in addition. So maybe a $10, $20 fee just for using the card to grab cash, and then the interest pays. You start paying the interest right then. There's no grace period. Um, but that being said, they can be a great source of emergency funds, and that's only works obviously if you do not carry a balance, so that you have access to that entire balance in case your entire credit limit in case you needed it. Um, APR, when you see a loan, it's typically quoted in APR, which is the annual percentage rate, right? You need to review credit card statements um, just as quickly as possible, and often you'll find perhaps fraudulent charges, duplicate charges, but also it gives you a chance to see where the money is being spent. Most credit cards now you get an annual statement that shows you over the course of the entire year, but even on any credit card, you can look at it month to month. Collateral. So collateral is related to secured loans. Um, Typically, a loan that has a good interest rate is going to be secured by some sort of tangible asset. So whether it be real estate, a car, or something like that, typically you can get a better interest rate on those loans because the lender has some recourse, as opposed to something like a credit card or just a signature loan, something like that that doesn't have an asset matched up against it. Typically, those are going to have a higher interest rate. But collateral um, is that notion that the loan is secured by um, by an asset that can be seized for lack of payment. Co-signing loans generally don't do it. Um, the person who you have the loan with, or the credit collection agency that gets involved if the loan's not paid, they have just as much you know interest in your assets as the person who is the originator on the loan. Once you co-sign it, you're completely liable for that loan. So they can come start taking your items for the loan that you signed for that other person. Um, when you buy a home, do you pay a real estate commission? No, the seller pays the real estate commission. So again, my advice to you, even though I don't do that business anymore, would still be to use a real estate agent when you're purchasing a home. Um, Typically you don't have any exclusive requirement. If you find something else on your own, you can negotiate that independently. But if that agent shows you something, then obviously part of the deal is that you're going to be paying their commission, but not you, but the seller will be paying their commission. Homeowners associations, yeah, love them or hate them. You know, they can do certain things, um, and some of it can, affect certain things you'd want to do to the property. And sometimes you're thinking, well, yeah, that's a good thing. I don't want, the house next door painted purple, but it can also get kind of crazy. I know here in Anchorage, well, actually, it's in Eagle River. A friend of mine was a he worked with the HOA, and his job was to count the trees, and every homeowner in that subdivision needed 3 trees, and if a moose came and ate one or a storm blew one down, you had to get another tree back out there. There will be 3 trees. 3 will be the number. All that. So anyway, it just seems a little not something I want to spend my time. Not people I want to meet. Fixed rate mortgage. How much does that change over the course of the loan? It doesn't, right? It stays exactly the same. So let's say you get a mortgage, and back when I was growing up, my parents had a 30-year mortgage that they took to conclusion, and I remember their payment was 133 bucks, which was nothing. Back in the day when they originated a loan, I'm sure that was 133 bucks was like a big deal. Obviously, we'd all love to have a mortgage payment for 133 bucks. But typically mortgages are 30 years. That's not etched in stone. As I said, you don't see typically the longer ones in the States, but in Spain, for example, 60-year mortgages were kind of the thing, which is just a weird concept. Um, Adjustable rate mortgages, they're kind of out of fashion right now, but you'll probably hear about them again in the future if interest rates go up. It's a way to get a lower interest rate if you're a bit of a speculator or you're just getting in for a short run. But what that means is you can get typically, well, you the only reason you do it is if you got a lower interest rate, but that interest rate can change if market conditions change. So it can be a little bit dangerous because it can make the house unaffordable if interest rates go up too much. Um, an insurance question: ignoring risk is not a risk management method, right? You can avoid things not very useful. You can accept risk. You can insure against it, but just ignoring it, pretend like I'll never crash, my house will never burn down. That's not a, a method of coping with that. Certainly not a suggested one. Comprehensive coverage on vehicles, that has to do with kind of the cats and dogs, the other things that happen other than accidents. So, you know, wind, hail, windshields, things like that. That is under comprehensive. Deductible, a deductible is amount that you will pay, or by default, another way to express that's the part that the insurance company is not paying. So if you have a $500 deductible and the damage to the car was 3 grand, you're gonna put up 500 and the insurance company would put up 2,500. Um, what's not covered in the standard homeowners policy? Flood insurance. So as I said, flood insurance, it goes against the insurance model. It tends to affect everybody at once, and so that's not a something that they can legitimately offer insurance for. Um, Talked about when you're having any sort of renter's insurance or homeowner's policy or really any type of insurance. If you've got a single item that's of great value and you think, oh, I've got homeowner's insurance, that'll cover all my guns I've got or the jewelry I have or whatever. No, you need to look at the limits on any policy you have, and there's typically limits within a category. In a category, for example, on jewelry, maybe losses up to $1,000 or something that's much smaller than what you've got. So you would need to get an additional policy, or at the very least, identify the items so that there's no confusion. If you've got a single large item, you definitely want to make sure the insurance company knows that you've got that item and squabble about it now rather than later when it's either lost or stolen or burned up or whatever. So you need a different policy. So sometimes they'll call them a rider, which is just a rider to the original insurance contract, or they'll, call them a float or a personal property float or personal article float or what have you. Um, how to reduce insurance? Um, Several different ways. I mean, this works on automobile insurance or home insurance or whatever, is except a higher deductible. If you have, for example, $1,000 deductible on a vehicle, then you will get a better rate than if you had a $250 deductible. You can still have, the same coverage for catastrophic damage if the car gets totaled out or something. But for the smaller stuff, you would have um, maybe no coverage, something like that, where the damage is, you know, short of $1,000, you probably short of $1,500. You're probably not going to report it to just get $500 from the insurance company. And the insurance company knows that, so they'll give you a lower rate for that. What's the most common form of health insurance? The means in terms of how people typically get insurance, and that's typically through their employer. The vast majority, 75, 80% of people get their health insurance through their employer. So we talked about a few other programs. We had Medicare for older folks. We had Medicaid for, folks that don't have the income. And now you also have the Affordable Care Act. It kind of falls in between there. It's with people who may not have a great deal of money, but obviously are above welfare status. And anyway, that's the program that's going to be changing based upon politics. So anyway, that's about it for the midterm review. Just a short little thing to kind of focus your study. Again, it's going to be on Blackboard. You can take it anytime during the week. You'll turn it in right there. It'll give you your score, multiple choice, 60-minute time limit. So um, you're not going to be able to do any sort of really open book because you're not going to have the time to do that. And that'll be that. Good luck on the exam.